On tariffs and sovereign wealth, President Trump is creating tools that future presidents will thank him for. Hello, this is Robert Romano, Executive Director with Americans for Limited Government and Americans for Limited Government Foundation. Hit that subscribe button. Today, we're going to be talking about President Donald Trump's plans for generating more revenues for the U.S. government and the American people via tariffs. This time, he's doing a 25% tariff on all automobiles, trucks, and car and automobile parts, truck parts coming from overseas. He's citing national security concerns, and this stems from a 2019 U.S. Department of Commerce report that was ordered up by Trump. It was actually held as executive privilege through the duration of his presidency while he was negotiating the USMCA, US Mexico Canada trade agreement, but also trade agreements with China and other countries around the world. And it was not released until July of 2021 under the Biden administration, after Trump had already left office. But what it found was that, as a matter of fact, the defense industry, our military, depends on a robust U.S. auto industry, which is declining as of this moment and for decades because of both insourcing, but also unfair trade policies directed at the United States that have helped hollow out U.S. manufacturers. There's other problems with the U.S. auto industry, kind of bloated labor costs and pension funds and things like that. A lot of that has to do, though, with the fact that America has a higher standard of living than in other countries, say Mexico, for example, where a lot of auto factories are being built right now. And so I think that there's a factor of our standard of living and just being the largest economy that has also made it more difficult for U.S. auto industry manufacturers to, gain market share. As opposed to those overseas. There's also, you could say the quality of the cars is better. It's like, oh, we buy the cars that are the best. So you could say that maybe the Germans and the Japanese are making better cars. That's certainly, I think, another argument. But as far as the United States is concerned, according to the U.S. Commerce Department, this study has been released now. It's definitely in the American people's interest to have a robust defense industry that depends on a robust auto industry. And we're going to take a look at that. We'll jump into my piece here. We're also going to talk about the sovereign wealth fund that President Trump is proposing. I'm saying, you're sitting on about $7 trillion of U.S. treasuries. And why just have useless government paper? These are the trust funds, not just Social Security and Medicare, but other departments and agencies will buy treasury bonds, mostly non-marketable, but also some marketable treasuries. And maybe a good way to help cure inflation. If you sell treasuries, you can take money out of circulation. That's certainly what the Federal Reserve does when it needs to strengthen the dollar. So with these trust funds, it's possible that you could actually remove some money from circulation. I know we printed about $7 trillion in response to COVID. And afterwards, under both the Trump and the Biden administration. So maybe, getting some of that money out of circulation is a good idea. Maybe some of that money could be reinvested into something more productive than government debt. But let's take a look at my piece here. President Trump's tariffs and sovereign wealth fund can restore American economic primacy and cut inflation. President Donald Trump has expanded his tariffs to include new 25% tariffs on all trucks and cars and all automobile parts being imported into the United States in a March 26 proclamation. There's that proclamation adjusting imports of automobiles and automobile parts into the United States. Citing national security concerns with outsourced automobile production, stating, quote, automobiles and certain automobile parts are being imported into the United States in such quantities and under such circumstances as to threaten to impair the national security of the United States. And Trump cited a February 2019 report by then Commerce Secretary Wilbur Ross. This was during the first Trump administration, publication of a report on the effects of imports of automobiles and automobile parts on the national security, an investigation conducted under Section 232 of the Trade Expansion Act of 1962 as amended. And we're going to quote from portions of this right here. Let's see here. Many of the most important innovations and technological advances over the past 100 years have come from the automotive sector, and the strength of the sector drives technological advancements in the defense sector. This is from the U.S. Department of Commerce 2019 report. Today, the defense sector is heavily interconnected and reliant on the automotive industry for research and development to meet current and future military requirements, such as vehicle electrification, autonomous driving, hydrogen fuel cell products, advanced semiconductor utilization, radar, laser and sonar ranging, global positioning system, navigation, anti-lock brakes, reduction in vehicle weight, or so-called lightweighting, and fuel efficiency efforts. Product development in partnership between U.S. automotive manufacturers and defense agencies results in technological advancements in military aircraft, space aircraft, unmanned aerial vehicles, missiles, and submarines. Now, this is me, but a weakening U.S. auto industry would invariably harm national security, with the report stating, quote, the United States automobile industry's technological leadership and innovation is quickly diminishing. In conducting this investigation, the Secretary has found that significant import penetration over the course of the past 3 decades has severely weakened the U.S. automotive industry, as American-owned production of automobiles and automobile parts has been reduced by imports and the domestic manufacturing base has weakened. Overall, the share of global R&D investments in the automotive sector attributable to the U.S. has significantly declined, and today the share of R&D conducted by American-owned companies is a fraction of the share conducted by foreign competitors. If production volumes continue to decline domestically, the United States' contribution to automotive research and development will further weaken and impede the automobile industry's ability to invest in the development of technologies that are imperative to maintaining a leading edge in U.S. military capabilities. So a strong U.S. auto industry is essential to national security, is what the Secretary of Commerce was saying in 2019. So specifically, at a time of war or national emergency, the military might need the U.S. auto industry to produce a lot of this stuff domestically. We can't be in a situation of war, potentially importing all of these very important military components, parts, and machines, quite frankly. According to the report, quote, in the procurement of military equipment, including military vehicles, automobiles, and automobile parts, the United States Department of Defense relies predominantly on suppliers located in the United States, both American-owned and foreign-owned. However, because in a time of national emergency, foreign-owned suppliers operating in the United States may not be reliable sources of equipment, the DoD must be able to rely on a sufficient presence of American-owned manufacturers for its military needs. So it's important to have strong domestic industries, not merely to be a wealthy nation, but to be a strong and secure nation. If you're dependent on other countries in a time of war, you might lose that war. At the time of the report, President Trump actually deferred publication of this Commerce Department report in the interest of completing U.S.-Mexico-Canada trade agreement, the USMCA. But eventually it was released during the former President Joe Biden's term of office. Again, here's that report. And there was actually an Office of Legal Counsel opinion about holding the report back. It was, kind of deemed a part of executive privilege. It says here, quote, the president may direct the Secretary of Commerce not to publish a confidential report to the president under Section 232 of the Trade Expansion Act of 1962, notwithstanding a recently enacted statute requiring publication within 30 days, because the report falls within the scope of executive privilege, and its disclosure would risk impairing ongoing diplomatic efforts to address a national security threat, and would risk interfering with executive branch deliberations over what additional actions, if any, may be necessary to address the threat. And we can, I believe, quote a little further from this, the opinion that it fell under executive privilege, that this report did, and was, quote, confidential presidential communication or disclosure of which would risk impairing ongoing diplomatic efforts and the deliberations. So we quoted that part. But now in his second term, President Trump is directly acting on the report and helping the U.S. auto industry to recover from decades of outsourcing by bringing production back to the United States. No more time to waste. President Trump's in his second term. He probably wanted to do this in his first term, but they were still closing out the USMCA. They wanted to get rid of NAFTA and try to improve it via, trilateral trade relations in that case. But for companies that want to avoid the new 25% tariff, it's simple. Just build the cars in the United States. The news of Trump's new tariffs come in anticipation of the April 2 reciprocal tariffs that will match other countries' tariffs on U.S. goods, which also appear to be long overdue to rebalance U.S. trade policy just to meet the taxes that other countries are levying on U.S. exports. For decades, the U.S. put up with this, but it shouldn't have to keep on doing that. But trade barriers can include monetary barriers too. In just the past year, the Canadian dollar has depreciated against the US dollar by 5%. I actually pulled this up from Google Finance. You can see over the past year, it was at about 74. A Canadian dollar was worth 74 cents. Now it's worth 69 cents. And the Mexican peso, it was worth 6 cents. Now it's worth 4.9 cents. That's depreciation. That's making exports into the United States cheaper. This is competitive devaluation, and it might not be reflected in the reciprocal tariffs because we're going to do trade adjustment for tariffs. But what about these competitive devaluations? By the way, those are forbidden by the USMCA. To cheapen exports to the United States. That should also be considered by President Trump, in my opinion. Financially, further devaluations by trade partners, which should be anticipated, will have the near-term, however, relative effect of strengthening the dollar, which in turn could result in falling commodities prices, given the inverse relationship between commodities and the dollar. So with a strong dollar correlating with lower commodities prices and a weak dollar correlating with higher commodities prices. We were talking about this last week. I've got the chart right here. It shows the blue line is the nominal broad US dollar index. And when the dollar is weakening, in 2008, for example, it was down 10% year over year. Well, commodities prices were going to the moon, you'll recall. Oil was going up really, really fast. So when you have a weak dollar, you're going to see very strong commodities. And conversely, in 2009, as the dollar was strengthening, as everyone was, markets were crashing, you had the financial crisis, everyone's buying Treasury bonds, and then the dollar is appreciating by as much as 20%, 22% year over year, then commodities prices are declining. So weak dollar, high commodity prices, strong dollar, low commodity prices for producer price index by commodity. You want to lower the producer price index? You want to lower the consumer price index? Strong dollar, Mr. President. And you can see this relationship pretty much work like clockwork over time. I think that it's an interesting, kind of proposition. You can actually strengthen the dollar if you want to rein in inflation. And there's several ways to do that. One way, or we should mention, though, the tariffs could actually help cut inflation, despite congressional Democrats' proclamations that tariffs are inflationary, when a lot depends on how trade partners respond to those tariffs. So if we make their goods more expensive via tariffs, they might do competitive devaluation. The Canadians and the Mexicans might do competitive devaluation to try to offset the tariffs, in which case prices might actually come down on some of those goods. We'll also raise revenue. Are we going to rebalance all of our trade overnight? Probably not. So President Trump is also planning on using this as additional revenue to the United States Treasury to help balance the budget. Now, I note this is where President Trump's proposed sovereign wealth fund, this was a plan for establishing a United States sovereign wealth fund. And the report is due, I believe, on May 3rd. And President Trump, he ordered the Department of Commerce, Department of Treasury to present a plan for a sovereign wealth fund. And I say it can make a big difference in not only helping to bolster U.S. production and balance trade, but also to shore up fiscal policy, with a report due again on May 3rd outlining the structure of the fund. Namely, the federal government is sitting on some $7.3 trillion of intergovernmental holdings of U.S. treasuries. Here's the national debt. 36.2 trillion, 28.9 trillion is held by the public. It's held by central banks overseas. It's held by the Federal Reserve. And then there's these intergovernmental holdings, 7.3 trillion, that are like the Social Security Trust Fund, the Medicare Trust Fund. Let's see here. We have the, what's the name of this organ? The Peter G. Peterson Foundation actually has a good readout on what intergovernmental debt is. Quote, intergovernmental debt records a transfer from one part of the government to another. As of December 2023, it was 7 trillion. Now it's 7.3 trillion. A 2 trillion, there'd be a 2.3 trillion increase from a decade ago. In almost all cases, such debt is held in government trust funds, accounting mechanisms to track money designated for a specific purpose or program. The largest holder of intergovernmental debt is the Social Security Old Age and Survivors Insurance Trust Fund, and Survivors Insurance Trust Fund, which holds about 2.6 trillion, or 38% of intergovernmental debt. Other accounts holding such debt include retirement funds for federal employees, Medicare's Hospital Insurance Trust Fund, and the Highway Trust Fund. So you can see here it's 2.6 trillion of treasuries in the Social Security Trust Fund, 1 trillion in the Federal Employees Retirement Fund, 200 billion in the Medicare Hospital Insurance Fund, and 187 billion in the Medicare Supplemental Medical Insurance Trust Fund, 147 billion in the Social Security Disability Insurance Trust Fund, Highway Trust Fund, 113 billion, Federal Housing Administration, 78 billion, Deposit Insurance Trust Fund, 24 billion, and then other trust funds by the government, 2.9 trillion. So yeah, maybe the 2.9 trillion is something you could tap into. Maybe the Social Security is something you could tap into, get a better return on investment for Medicare as well. I think that, right now the Social Security funds are, and these bonds, these non-marketable securities, they're only earning an average interest rate of 4.3%. And an effective interest rate of 2.5%. So you could be doing much better than that, just with market returns. I argue maybe you should look at what members of Congress are, buying on the stock market. It outperforms the stock market. Members of Congress, when they buy stocks, they do better than the S&P 500 does by a lot. Let's see. This is from Yahoo Finance, Alicia Adamczyk. Democratic and Republican lawmakers can't agree on much, but there is one practice among members that enjoys bipartisan support: individual stock trading. The portfolios of dozens of members of Congress from both major parties outperformed the benchmark S&P 500 in 2024, according to the annual analysis of the politicians' stock portfolios by Unusual Whales, a financial startup run by an anonymous tracker. So if members of Congress know how to beat the stock market, well, maybe we could save the Social Security and Medicare trust funds, which are going to get depleted in the 2030s. All of these treasuries are going to be converted into cash and then converted into benefits if they can't find a way to start growing the trust funds right now, which is what I'm arguing that you can do with President Donald Trump's plan for the Sovereign Wealth Fund. We can save the Social Security and Medicare trust funds just by reinvesting. Instead of buying useless government paper, maybe we should be investing in the U.S. economy. Maybe the Sovereign Wealth Fund, maybe it can establish, its base money from these trust funds. I think that we could definitely do a better job of managing it, of managing the American people's monies. Like the worst thing would be to just have it be cash. If the Social Security and Medicare trust funds, if that had just been cash, they might have been depleted long ago. The only reason that we still have trust funds is because they've been earning some interest over the years. So the getting a return on investment that has, lengthened the duration and the longevity of the Social Security and Medicare programs. So I think this is an important feature. It's just that you're not getting a good enough return on investment. You could do the S&P 500, for example, you'd probably get 6% or something like that, or 8%. Depending on what you want to get. But, certainly members of Congress know how to beat the stock market even. So apparently there's really smart investment strategies that could be undertaken. We're just not doing it right now. And so I argue you want to fight inflation, Mr. President, you could direct the Treasury and other departments to begin selling some of those trillions of dollars worth of treasuries, directly taking money out of circulation. Similar to the Federal Reserve's open market operations, this could bolster efforts to temporarily strengthen the dollar to combat inflation. But there are side effects, as dumping treasuries can increase their public supply, thereby temporarily increasing interest rates. So when you have people selling treasuries, interest rates go up. When people are buying treasuries, interest rates go down. On the other hand, reducing inflation could ultimately help rates come down that banks are charging, interest rates, as institutional investors hedge against potential slower growth by buying bonds. And then at appropriate times, the sovereign wealth fund could also reinvest the monies into U.S. companies. I say the S&P 500. It'd certainly be better than the rate of return we're getting from the interest of the non-marketable treasuries. Let's convert those to marketable treasuries. You can kill inflation, reinvest that money, and probably save the Social Security and Medicare trust funds. Maybe even help to balance the budget. This can be done at times of market lows and could have the impact of temporarily weakening the dollar, which can be useful if other countries, whether Canada, Mexico, or China, are utilizing competitive devaluation. So you don't want to repeat of the 1930s, where we were just allowing the dollar to get really, really strong while the rest of the world was engaged in competitive devaluations. We watched unemployment go to the moon, about 25%, as all these other countries were coming off of the gold standard and artificially made the dollar stronger. And that made unemployment go to the moon until FDR got elected. And then he said, we need to offset this. You have to weaken the dollar in order to offset what all the trade partners were doing. At that time, it meant coming off of the gold standard temporarily. And then after the war, the gold standard was reinstated, but then it came off of it again in the 1970s because similar problems. Now, long term, this could help grow the trust funds, which Social Security and Medicare will be exhausted by the 2030s. Why sit around and wait for that to happen? Just go get a better rate of return. The U.S. Treasury Department, I think, in consultation with the Commerce Department and the White House, they can do a better job with this. And I think this would serve all future administrations. I think these are tools President Trump is creating that future presidents will be able to utilize. Or just get the best institutional investors. I said we can see what members of Congress are buying. What are their stocks? Maybe that would be a better return if they're getting a huge rate of return. Maybe, the Social Security, Medicare trust funds could get a better rate of return too. Or just get the best institutional investors to help do that. You could probably, get, the JP Morgans. They know what they're doing. They know how to grow their hedge funds. Not only is this a long overdue, but it's also really a race against time thanks to lower fertility globally and the aging workforce. There are simply far fewer taxpayers than there otherwise would have been to support the baby boomers' retirements. Taken broadly, President Trump is potentially killing a lot of birds with just a few stones through a combination of these policies. I argue tariffs, treasury sales, sovereign wealth fund investments. The president is creating ready tools for all future presidents, regardless of party, to restore American manufacturing, bolster national security, fight inflation, and shore up the nation's fiscal health. They can thank him later. This is Robert Romano, Executive Director with Americans for Limited Government and Americans for Limited Government Foundation. Hit that subscribe button, ring the bell for notifications, and have a good day.